Phantom debt continues to grow across the US economy, and this is something that's going to affect the housing market as we move into 2024. On top of CPI starting to come down in many categories, at least month over month, that the Bureau of Labor Statistics tracks, and of course, the Federal Reserve is watching closely. There's also this Afterpay, the buy now, pay later. These companies like Afterpay or Affirm, where you can buy a good and put that on a monthly payment plan. So a lot of times there's no interest or it's an upfront fee, so you don't have to pay the whole price out of pocket. But these lenders are lending more than ever, and this is lending that does not come up when we talk about consumer loans and other revolving loans like credit card debt. And it's something that the Federal Reserve isn't really talking about, but I guarantee you they're looking at this as a measure of how strong the US consumer is because despite wanting to get inflation down, they don't want to significantly crash the economy based on having their monetary policy too tight. And I have proof of this that I'm going to bring up later in this video as we talk about how this is going to affect the housing market moving into 2024. So let's get into the first article here. But first, my name's Liam O'Reilly. I'm a realtor here in Vermont with Jerry Riley Real Estate. If you have any real estate needs in Vermont or anywhere across the country, reach out to me directly. All of my contact information is in the description. I would be happy to help you. And let's get into the first article here. So, unregulated danger zone, phantom debt, and fast growing buy now, pay later usage could be worse than anyone knows. So, again, this is debt that the Federal Reserve isn't really keeping track of when or they're not they it's not impacting their charts when they talk about household debt spending, debt to income spending, because this is different than credit card debt or other traditional debt that buyers have used to purchase in the past. And if we look at the growth, so in 2019, there were about 16.8 million loans, resulting in about $2 billion worth of money being lent out to these consumers. In 2021, that skyrocketed by about 10% to 180 million loans and $24 billion being lent out. And now in 2023, right there in the highlighted section, providers estimate that the loan values for 2023 will come in around $46 billion. And let's scroll down to the next section here. Look, right, this second highlighted section, because no central repository exists for monitoring it, growth of this phantom debt could imply that total household debt levels are actually higher than traditional measures, such as the measures that people usually use when talking about inflation and consumer debt. And remember, consumer debt is at an all-time high. When we take a look at credit card debt, we're at an all-time high here at over $1 trillion. Now, $40 billion out of this trillion is not that large of a drop in the bucket when we're talking about all total debt, but these are the buyers using this phantom debt are primarily high risk for default. They're buyers that are stretched thin, who don't want to put this on a credit card, and they're really struggling right now. The U.S. consumer, especially at the margins, at the lower end, is really struggling with higher inflation. And so, basically, this is what's going on with the U.S. consumer. It shows how weak it is, how weak the average consumer is. And if we look at just the numbers from from Cyber Monday here, according to Adobe Analytics, these services drove in about $940 million in online spending just in Cyber Monday alone. So consumers are putting a ton of money on this phantom debt that's not being tracked. Now, I guarantee the Federal Reserve is looking at this when deciding whether or not to hike rates. And the reason why I think this is I'm reading this book right here called Building from the Ground Up by Kevin Erdman. I'd highly recommend it. I'm only about 50 pages in, but listen to this section here. So he's talking about a study that was given to Congress talking about the 2007 financial crisis. And this is what it says. Both of these problems are attributable in part to the Federal Reserve's too tight monetary policy, a decade-long series of errors. These errors ran all the same direction, curbing spending too much. This helped cause, deepen, and lengthen the output gap. And they talk here about how the Federal Reserve, how the FOMC acknowledges this, how they acknowledge that they kept their policy too tight for too long during the great financial crisis, and that helped cause the financial crisis as well as deepen it. Now, the Federal Reserve, their stated goal is obviously 2% inflation, and that's something that everyone's been focused on, but also maximizing employment. Now, I do think they want to see unemployment come up slightly to see a little bit more people unemployed, but they don't want to cause another great financial crisis. That is not their goal. Despite what some people may say here on YouTube, they're trying to engineer a soft landing. They're trying to not enter us into another great recession or an economic depression. And I think they're looking at this phantom debt. They're looking at the how hard it is for the average consumer out there, and they're taking that into account when making their policy decisions, which of course affects the housing market because it affects where mortgage rates will be, right? If rates are higher, that means investors can put their money with the Federal Reserve in their overnight lending facility and get a guaranteed high interest rate. But if they expect rates to come down in the future, which I think a lot of people are betting on, that's why we see mortgage rates start to come down as the prices for these mortgage-backed securities start to rise and the yields drop because there's more demand for them. So how will this affect home prices as we move into 2024? Now, there's a lot of buyers out there who are sitting on the sidelines. And Zillow estimates from this article out of Yahoo Finance that more than half of potential home buyers are waiting for lower mortgage rates or for home prices to fall before considering buying. So according to this data, there's about twice as many buyers who want to buy a home than are out there actively looking for a home right now. But if we see mortgage rates stay around where they are right now, again, they've come down from their 8% highs and they now sit right at around 6.5%. Here in Vermont, the best you can get is 6.3%. So quite a bit lower than their 8% highs, which is going to bring more people into the housing market, especially if rates stay there. If they don't seem like they're going to drop significantly, that's going to bring more home buyers into the overall housing market. And right now, we're not seeing a drop in home prices across the country. We're not seeing a drop here in Vermont or, broadly speaking throughout the US. This is a chart from October, the most recent data out of the Federal Reserve Bank of New York, which tracks home prices. And we can see how things have improved on a year over year basis compared to this summer. June and May, home prices were basically flat at 1.7%, major declines. This brown area, those are counties where home prices declined. So primarily on the West Coast, and then the East Coast saw solid year over year growth. But now, as we move into October, we're seeing year over year growth pretty much throughout the entire country. Aside from a handful of counties that are still experiencing year over year declines, and we see this in the Redfin data as well. That median sales price, of course, at the beginning of this year was under the 2022 levels, but now has remained over the 2022 levels and is remaining relatively stable. Yes, it's gone down slightly. The line is trending slightly down, but we're not seeing a significant drop in home prices despite a weakening consumer, despite higher mortgage rates, and despite high home prices. Home prices are remaining stable because fundamentally we've underbuilt homes for such a long period of time that there's so many buyers out there who want to purchase a home. So the minute that home prices start to come down, the minute that mortgage rates start to drop, we see more buyers jump into the housing market. So as we move into 2022, I think the weakening consumer, the large amount of phantom debt, the high consumer debt, the consumer delinquencies, that's going to affect monetary policy and the Federal Reserve more than anything. The Federal Reserve doesn't care about home prices shooting way up or going way down. Yes, they want general stability in the housing market, but that's not a part of their inflation numbers. So they're going to look at the consumer, they're going to look at inflation, they're going to try to keep this economy running, keep us out of a recession, which I think means that we're done tightening on the Federal Reserve's, and they've said it, that they're done tightening, that they're not going to tighten anymore, or at least that's the outlook. Now, they're not ruling it out, but it's pretty much baked into the markets that they're not going to tighten anymore. And because of how low inventory is, I think we're going to see home prices remain flat or tick up a little bit. We're not going to see a crazy shoot up in prices like we saw in 2021 and 2022, but we're going to see more buyers come out of the woodwork and come into the market as they realize that home prices aren't falling, aren't going to drop off a cliff, and that interest rates are also not falling significantly, assuming there's no major economic crash in the economy. And in that case, then then we could see rates fall significantly. Then we could see unemployment shoot up. But still, I think the most likely scenario as we move into 2024 here because of how low inventory is, because of how many buyers are waiting on the sidelines wanting to buy a home right now, we're going to see home prices remain stable or start to tick up as we see mortgage rates slowly tick down. So, anyways, I hope you guys got something out of this video. Thank you for watching. Merry Christmas, happy holidays. Leave me a comment, let me know what you think, and I'll see you in the next video.